Good evening, everyone.
Good evening, sir.
Good evening, sir.
So this night, we shall be looking at a topic called capital gain tax. So that is the topic we are going to look at this night. We are going to look at what capital gain tax. How do we compute capital gain tax? Just for the notice, this topic, capital gain tax, by January 2026, there's going to be a changes in the mode of computation of capital gain tax. So the capital gain tax rate as at present is 10%. But according to the Nigeria Tax Act, the rate of capital gain tax as from next year is going to be based on either company income tax rate or personal income tax rate. So what is capital gain tax? What is capital gain tax? We need to start from there. Capital gain tax simply means a tax imposed on a gains arising from disposal of chargeable assets. Capital gain tax is a tax imposed on a gain arising from what? Disposal of chargeable assets. What do we mean by chargeable assets? Those assets that appreciate in value. Chargeable assets simply means fixed assets, but those fixed assets that normally appreciate in value. Example, land and building, motor vehicles, sometimes furniture and fitting, plant and machinery, they appreciate in value because some of those assets, some of those fixed assets, because we normally import them to Nigeria and the rate of exchange day by day. But land, when you buy land 5 years ago, 10 million naira, if you want to sell the land now, because of time value of money, you can't sell it the price you buy it again. You will sell it more than the price. Assuming you bought a land that worth 5 million naira, 10 years back, you now want to sell it, you sell it 50 million naira because the land has appreciated. The difference between sales proceed, which is the 50 million naira, and the cost of acquisition, 5 million naira, that difference between two of them is the capital gain. That means we less the cost of acquisition from the sales proceed, we are going to get capital gain. The law said you must pay a capital gain tax of 10% of that 45 million naira. You will pay a capital gain tax. So as at present, the rate of capital gain tax is 10%. So capital gain tax simply means a tax imposed on a gain arising from disposal of chargeable assets. The word chargeable asset means fixed assets. So that is the meaning of capital gain tax. Administration of capital gain tax. Who administers capital gain tax? Who is the tax authority responsible for assessment, collections of capital gain tax? The administration of capital gain tax depends on the nature of the transaction. What do we mean by the nature of the transaction? Who made the gain? Is it a company? Is it a corporate institution or company that made the gain? Sorry, if the gain is made by an individual, if the capital gain arising from transactions relating to individual, sole proprietorship, partnership, sole trader, the capital gain tax is going to be collected by State Board of Internal Revenue Service. But if the gain arises from transaction related to a company, corporate institution, the capital gain tax is going to be collected by Federal Inland Revenue Service. That means what we are saying in essence is capital gain tax is collected by both Federal Inland Revenue Service and State Internal Revenue Service. It depends on who made the gain. It depends on who dispose the chargeable assets. So that is it on capital gain tax administration. So the next area that we need to move to relating to this capital gain tax, basis of assessment of capital gain tax. How do we assess capital gain tax? How do we assess them to tax? What are the basis of assessment of capital gain tax? Capital gain tax is assessed to tax on actual year basis. Capital gain tax is assessed to tax on actual year basis. What do we mean by actual year basis? The capital gain that you made in 2025 is going to assess to tax in the year 2025. That means, as at present, if you made any capital gain arising from disposal of chargeable assets, you are going to pay tax on that capital gain in this 2025. This actual year basis under capital gain tax is going to be divided into two. Capital gain arising from transaction from January up to 30th of June. When you made any capital gain arising from disposal of assets from January up to 30th of June, you must remit the tax relating to that capital gain tax on or before 30th of June. And second part, when you made a gain from disposal of assets from a period that starts from 1st of July up to 31st of December, the capital gain tax must be remitted to the relevant tax authority on or before 31st of December. Somebody send a message now that the person is just joining the class, just joined the class, that I should do a recap, a brief recap. The topic we are doing is on capital gain tax. We just started and we have defined capital gain tax. We said the capital gain tax is a tax arising from a gain on a disposal of a fixed asset. Capital gain tax is a tax imposed on a gain arising from disposal of chargeable assets. Chargeable assets simply means fixed assets. And we talk about the administration of capital gain tax. We said capital gain tax can be administered by either State Board of Internal Revenue Service, or can be assigned Inland Revenue Service and State Board of Inland Revenue Service, State Board of Internal Revenue Service collect capital gain tax. If the gain is made by an individual, if that gain accrue to an individual, sole proprietorship, partnership, the capital gain tax will be assessed to tax by State Board of Internal Revenue Service. But if the gain accrued to a company, corporate organization, the capital gain tax will be assessed to tax by Federal Inland Revenue Service. So, basis of assessment of capital gain tax, that is where we are presently. We said capital gain tax is assessed to tax on actual year basis. Actual year basis simply means any capital gain arising from disposal of chargeable assets in this present year, 2025, is going to be assessed to tax in 2025. However, the actual year basis under capital gain tax, we divide it into 6 months. When you made a capital gain from disposal of assets from a period starting from 1st of January up to 30th of June, the capital gain tax must be remitted not later than 30th of June. But when you made a capital gain arising from disposal of chargeable assets from 1st of July up to 31st of December, which is the second half of the year, the capital gain tax must be remitted not later than 31st of December. That is it on basis of assessment of capital gain tax. Who are the persons liable to capital gain tax? Who are the persons liable to capital gain tax? Who is responsible for payment of capital gain tax? Number one, individual. Me and you, we are individual, either resident or non-resident. Resident individual means a person that domicile or reside in Nigeria. While non-resident individual means those individuals that does not domicile in Nigeria, but they derive income in Nigeria. How do we determine resident of Nigeria? When you reside in Nigeria for more than 183 days, you are a resident of Nigeria. But if you don't reside in Nigeria for more than 183 days, you are a non-resident. Non-resident means you are not residing in Nigeria, but you are deriving income in Nigeria. So those are the individual. Partners too is liable to capital gain tax. When any of the partner made a gain from disposal of a chargeable asset, they are liable to payment of capital gain tax. Trustee in a settlement arrangement. Trustee, someone that manage property under a trust. Property under a trust or administration. Somebody that manage the property. They are also liable for payment of capital gain tax when they made a gain from disposal of chargeable assets. Likewise too, companies too. Companies. Registered company, PLC, limited, they are liable for payment of capital gain tax. So these are the persons liable to capital gain tax liability. So now we can proceed further. Let's look at concept of disposal. When do we assume under Section 6 of the Capital Gain Tax Act 2004, this section talk about how do we determine whether disposal have been taking place or not? How do we determine whether disposal of an asset, we mean chargeable asset, have been taking place or not? So disposal of assets can take place when the following circumstances occur. According to Section 6 of this Capital Gain Tax Act 2004, Disposal of an asset is going to take place when these following conditions occur. Number one, by way of compensation for any loss of office. When any capital sum is derived by way of what? Compensation for any loss of office. Compensation for loss of office. You receive a compensation for loss of office, meaning maybe you are being paid for they want to do an improvement in your department, so they have to retrench some staff and so on like that. So they ask some people to go. They pay them some payoff. Such kind of payoff, they are liable to capital gain tax. But this compensation for loss of office, Finance Act 2021 said when the compensation for loss of office is not more than 10 million naira. If the compensation for loss of office is not more than 10 million naira, it's not going to be liable to capital gain tax. But if the compensation for loss of office is more than 10 million naira, it's going to be liable to capital gain tax. So disposal is taking place by way of receiving a capital sum from compensation for loss of office. Another situation or condition where a disposal is going to be taking place, when you receive a capital sum by way of what? Insurance policy. When you receive an insurance compensation as a result of loss or injury suffered, maybe as a result of fire incident, or as a result of accident, motor accident, or as a result of injury suffered. When you due to group life insurance, when you receive a compensation, it is deemed that disposal is taking place. Another condition where a disposal is taking place, where any capital sum is received in return for forfeiture or surrender of rights. When any capital sum is received in return for forfeiture or surrender of rights, maybe you have a patent right, or you have a copyright, or you have a trademark. You now need to sell that trademark, patent right, copyright to another party. When you receive the capital sum for selling out your trademark or your corporate brand, that means disposal is taking place. Another one where disposal is taking place, when you receive a capital sum, when any capital sum is received as consideration for use or exploitation of any assets. This one has to relate to lease, asset lease. When any capital sum is received as consideration for use or exploitation of any asset, that means disposal is taking place. Another condition where a disposal is taking place, when any capital sum is received in connection with or arises by virtue of trade, business, profession, vocation. This one is more common. When you sell your assets, or you sell good, or you render service, that means disposal is taking place generally. These are all the conditions that facilitate disposal of an asset according to Section 6 of Capital Gain Tax Act 2004. Now, let's look at how do we compute this capital gain tax. As we all know, as at present, the rate of capital gain tax is 10%. That means 10% that 10% is going to apply on the capital gain that you made. Example, you purchase a land in 2015. You purchase the land 10 million naira. 2025, you want to sell the land 10 years after. You now sell the land 70 million naira. Sales proceed is 70 million naira. Cost of acquisition is 10 million naira. The difference between the two is the capital gain, which is 60 million naira. That 60 million naira capital gain, you are going to compute capital gain tax of 10% on it. 10% of 60 million naira. That means you will pay a capital gain tax of 6 million naira. So as at presently, the rate of capital gain tax is 10%. Like I said, as from January 2026, this rate is going to be determined by either company income tax rate or personal income tax rate. Now, let's look at the format. We are still going to look at all those points, but we want to look at the format on how we compute capital gain tax. How do we compute capital gain tax? If you want to compute capital gain tax, we have sales proceed less incidental selling costs. Incidental selling cost means those expenses that you incur while selling the assets, those expenses that you incur for improvement of the asset, even that if you don't incur those expenses, you cannot sell the asset, you cannot dispose the asset. Example of incidental selling costs: advertisement costs. When you advertise in Facebook or in any social media handles that I want to sell this asset, it's incidental selling costs. Agents fee, the agents that help you to get the buyer. The agent fee that you pay is incidental selling costs. Another one, improvement costs. Before you sell the asset, maybe you have to do some repairs. They are incidental selling costs. You have to less them from your sales proceed. Let me give an example. I sell a land. Take for instance, I have a land. I now sell the land 70 million naira. The agent that brought the buyer said he's going to collect 5% agency fee. 5% of 70 million naira. That is 3.5. So if I want to compute my capital gain tax, 70 million naira is going to be here. I will less incidental selling cost, which is agency fee, 3.5 million naira. I will less that so that I can get my net sales proceed. Once I get my net sales proceed, I can now less cost of acquisition. Cost of acquisition means the cost incurred when you acquire the assets. Cost of acquisition consists of purchase cost of the assets, installation costs, carry costs of the assets, and cost of protecting the assets. That means cost of maintaining the assets while you are looking for buyers, or while you are using the asset, before you use the assets. Cost of the storage cost. You put the assets in a warehouse. Those amount you incur, they will be added as part of cost of acquisition. Any cost that you incur at the point of purchase of the asset, aside from the purchase cost, is part of incidental selling cost. Is part of incidental selling cost. So these are, you will less your cost of acquisition from net sales proceed. You will less your cost of acquisition from what? Net sales proceed. You are going to get capital gains. Assuming my capital gains is 10 million naira. If I want to compute my capital gain tax, 10% of 10 million naira, that is 1 million naira is the capital gain tax I'm going to pay on this transaction. These are the formats on how we compute capital gain tax. Now, let's talk about allowable expenses and disallowable expenses relating to capital gain tax. What are those allowable expenses relating to capital gain tax? The allowable expenses relating to that capital gain tax, they are those incidental selling costs that you incur while disposing the asset. When you want to dispose the asset, or after you have disposed the asset, those incidental selling costs that you incur, they are allowable expenses. Secondly, allowable expenses also include the cost of acquisition, which is the purchase cost of the asset, the cost that you use to purchase the asset, or any cost that you incur for improvement of the lifespan of the assets. So, according to the section 14 of Capital Gain Tax Act 2004, allowable expenses include, number one, purchase cost of acquisition, which is purchase cost, purchase price, or purchase cost. Number two, improvement cost. Improvement cost. When you acquire the assets, for you to use the asset, you need to do some installation, do this, and so on like that. It's part of allowable expenses. Another one, incidental cost of disposal, which is incidental selling cost, which include agency fee. Agency fee is an allowable expenses. Professional fee is part of incidental selling cost. Maybe you have to value the asset before you dispose it. You may invite estate valuer to come and help you to value the assets, or at the point of selling the assets, you need to do some legal agreement. They are professional fee. Or you invite auctioneer to help you sell the asset. They are professional fee. They are incidental selling costs. This incidental selling cost too is an allowable expenses according to the section 14 of CETA. Advertisement cost. Cost of advertising the asset while looking for buyer is an allowable expenses too. It's also under incidental selling cost or incidental cost of disposal. Stamp duties. Why at the point of purchasing the acquisition of the asset, at the point that you acquire the asset, you pay some stamp duties It's part of incidental selling cost. It's part of cost of improving the asset. It's an allowable expenses. Or at the point of disposal of the assets, at this point of disposing the asset off, you need to do some agreements or pay some stamp duties. It's an allowable expenses. Transfer of ownership, deed of assignment. You need to do deed of assignment at the point, either at the point of purchase of the asset or at the point of disposal of the asset. It's an allowable expenses. All these are the allowable expenses. But this section 14 of CETA group the allowable expenses into 3. Number 1 of them is cost of acquisition. Number 2, improvement cost. Number 3, cost that is wholly, exclusively, necessarily incurred for defending the owner title of the asset, which is the legal cost. While number 4, incidental cost of disposal. Under the incidental cost of disposal, we have advertisement cost, we have cost of transfer or conveyance, which include stamp duties. We have professional fee paid. We have agency fee or agency commission. So these are the allowable expenses under capital gain tax. Disallowable expenses under capital gain tax. Disallowable expenses under capital gain tax. What are the disallowable expenses under capital gain tax? Number 1, all those allowable expenses under company income tax or personal income tax. What do we mean by that? If we want to compute adjusted profit under company income tax, or you want to compute adjusted profit under personal income tax, all those allowable expenses like telephone, printing and stationery, repair and maintenance, salaries and wages, internet, subscription, you have used them already in another type of tax, which is either company income tax or personal income tax. You cannot come and use them as an allowable expenses under capital gain tax. That means, number 1, disallowable expenses under capital gain taxes. All the allowable expenses in computing adjusted profit under company income tax or personal income tax, they will be treated as a disallowable expenses under capital gain tax. Why? You have allowed them under company income tax in computing your adjusted profit or accessible profit or your total profit. You have allowed them under your personal income tax in computing your adjusted profit or your total profit. You cannot come and use them again in capital gain tax. That means you want to claim the expenses twice. That means you want to double count the expenses. Since you have used them in personal income tax, in company income tax, you cannot come and use them capital gain tax. So all the allowable expenses deducted in computing adjusted profit under company income tax or personal income tax, they will be treated as a disallowable expenses under capital gain tax. Another disallowable expenses under capital gain tax is insurance premium. Insurance premium. When you insure the assets. When you insure the asset, maybe you insure the land or you insure the motor vehicle, you now dispose the motor vehicle. The insurance premium you pay, you cannot add it as part of the cost of acquisition of the motor vehicle. No. Or you cannot less it from the sales proceeds as part of incidental selling costs. No, the law does not allow that. Another one, higher purchase interest. Higher purchase interest. Maybe at the point of acquisition of the asset, you acquire the asset through higher purchase transactions. You know that in higher purchase transaction, the difference between the higher purchase price and the cash price is the higher purchase interest. If in the long run you want to dispose the assets, your cost of acquisition will be the cash price, not the higher purchase price. By using the cash price as your cost of acquisition, that means you are treating the interest arising from the higher purchase transaction as a disallowable expenses. You don't incorporate it while computing your capital gain tax. Example, let me give a clear example. Let me give a clear example. Let me give a clear example. MV, motor vehicle. I bought a motor vehicle. The higher purchase price is 2 million. But cash price is 1.8 million. I decided to buy the asset through higher purchase. That means I'm going to pay 2 million. The difference between this cash price and the higher purchase price is the higher purchase interest. This motor vehicle, after I purchase it, 3 years after, I now dispose it. Disposed. I dispose the motor vehicle. I dispose the motor vehicle. When I dispose the motor vehicle, how much did I dispose the motor vehicle? I dispose it 3.5 million. Now, if I want to compute my capital gain tax, if I want to compute it, I would rather said my sales proceed, my sales proceed is going to be 3.5. 3.5 million. Less, what will be my cost of acquisition? Who can tell me my cost of acquisition? Who can tell me my cost of acquisition?
That is 1.8 million. 1.8 million.
1.8 million will be our cost of acquisition. 1.8 million. Instead of 2 million. That means that interest is treated as a disallowable expenses. I will recognize the cash price as the cost of acquisition, not the higher purchase price. So that is on higher purchase. So number 2, disallowable expenses under capital gain tax is higher purchase interest. Another disallowable expenses under capital gain tax, which is number 4. Number 1 is all the allowable expenses under company income tax and personal income tax. Number 2 is insurance premium on the assets, while number 3 is higher purchase interest. Number 4, bad debt in case of default in payment by the buyer. If the buyer of the assets default in payment, you cannot say you want to, the bad debt is going to use to reduce the cost of the asset. No, the bad debt cannot be treated as an allowable expenses. The bad debt will be treated as a disallowable expenses. So the bad debt will be treated as a disallowable expenses. So That is allowable expenses and disallowable expenses under capital gain tax. Now, how do we file capital gain tax return? What is the due date for filing capital gain tax return? The return on capital gain tax is filed twice in a year. Capital gain tax return is filed twice in what? In a year. The first return must be filed on 30th of June, while the second return must be filed on 31st of December. Return relating to a transaction arising from January to June must be filed 30th of June. While return relating to a transaction, capital gain tax transaction arising from 1st of July to 31st of December must be filed not later than 31st of December. That is on capital gain tax return. Failure to file a return. What is the penalty for failure to file capital gain tax return? If you fail to file capital gain tax return, what is the penalty? Failure to file capital gain tax return will attract a penalty of 10% plus interest at ruling commercial rate. Failure to file capital gain tax return is going to attract what? Penalties of 10% plus interest at what? At ruling commercial rates. These are the capital gain tax return and penalty for late filing. So if you fail to file capital gain tax return within the due date, which is 30th of June or 31st of December, you are going to pay a penalty of 10% plus interest at ruling commercial rates. Now, the next heading that we need to go to is assets or gains subjected to capital gain tax. What are those assets or gains subjected to capital gain tax? What are those assets or gains subjected to capital gain tax? Assets or gains subjected to capital gain tax. Number one, the asset or gains subjected to capital gain tax is listed in the section 3 of Capital Gain Tax Act. Section 3 of Capital Gain Tax Act state out clearly all those assets or gains that are subjected to capital gain tax. Number one of them is called incorporeal properties. Incorporeal properties. Incorporeal property means fictitious assets, e.g., goodwill, copyright, trademark, patent rights. All those intangible assets, they are incorporeal property. They are fictitious assets. You cannot. They are not tangible assets. So they are intangible. They are as a result of intellectual rights. So they are subjected to capital gain tax. So number one assets that are subjected to capital gain tax are incorporeal properties, example, goodwill, copyright, trademark, patent rights. This incorporeal property, when you subject it to capital gain tax, they don't have cost of acquisition. They will only have sales proceeds. Sometimes they may have selling costs, which is incidental selling cost, but they don't have cost of acquisition. Another one, options. Options too Options means purchasing rights. Options means purchasing rights. Purchasing rights are also purchasing rights. They are orders. They are subjected to capital gain tax. Let me explain that. You can be given a purchasing right and you later dispose the purchasing right. Example of purchasing right. You have a filling station. You are one of the major distributors of PMS. You have like 10 filling stations or 20 filling stations. So, and you are the major customer to Dangote Refinery. Dangote Refinery can give you options that XYZ Petroleum Company, if you can buy 50 truck of PMS, presently we are selling one truck of PMS 60 million. But if you are buying 50 and above, we are going to sell one truck for you, maybe at the rate of 47 million instead of 50 million. And based on your capacity, you cannot buy, maybe because of your filling station capacity, you cannot buy 50 truck at a time. Maybe you can only buy 35 truck at a time. The remaining 15 truck, you can sell it to other petrol filling station, other downstream filling station. You can sell it to them. You can sell the remaining 15. How do you sell the remaining 15? You know that Dangote is giving you 47 million per truck. The company that you want to sell it to, you may say, I have an option to buy a truck, 47 million per truck in Dangote Refinery. But I will sell this option to you 48 million naira. So that you too can go and buy it, so that you too can take advantage of it. The difference between that 48 million naira and the 47 million is the capital gain, and you are going to pay capital gain tax of 10% on it. That means you have sold your purchasing rights because you don't have money to utilize the purchasing rights. You don't have capacity to utilize the purchasing rights. You have sell it to another party, and that other party is going to be the one that is going to exercise the right. The difference between the amount you sell it and the amount, the discounted rate given to you, you are selling it, for example, you sell it 48 million naira and you are giving a discounted rate of 47 million naira. That 1 million naira gain that you made is an option. It's a purchasing right. You are going to pay capital gain tax on it. Another asset subjected to capital gain tax, debt. This one have to do with debt factoring. You factor a debt. You made a gain. Why factor a debt? That gain that you made, you will pay a capital gain tax. Take, for instance, XYZ Limited have a customer that is owing them 20 million naira. That is affecting their working capital. And the customer promised that he's going to pay within 90 days. XYZ Limited cannot wait till the maturity of the debt. they can go to a company, another company, to go and factorize the debt. They'll go and sell off the debt. Instead of collecting 20 million naira, the company will pay them maybe 9.5 million naira. That means XYZ has lose 500,000. It is the company that paid them 9.5 million naira that will collect the 20 million naira from the customers. By doing that, that company that collect the 20 million naira, they have made a capital gain. The difference between the factory, the discounted amount, and the actual price, 20 million naira, 9.5 million naira. That means that company have made a gain of 500,000. They will pay a capital gain tax on that 500,000. That is on debt. Another asset that is subjected to capital gain tax is any other currency other than Nigeria currency. When you sell a foreign currency, you sell a dollar, you made a gain, you pay capital gain tax. So take, for instance, I buy $1,000 at the rate of 1,200 naira to $1. When I want to sell the dollar, I now sell it back at the rate of 1,005 to $1. That means I've made a capital gain of 300 naira on each of the dollar. So for the $1,000, I've made a capital gain tax of 300 naira times 1,000. That means 300,000. That capital gain I made gain, I'm going to pay capital gain tax on the capital gain. So when you make a gain from disposal of foreign currency other than Nigeria currency, you are going to pay capital gain tax on the gain. Another asset subjected to capital gain tax, stock and share. Stock and shares. Stock and shares. Stock and shares. Stock and shares, they are subjected to capital gain tax. When you buy your shares or your stock, when you buy your shares or stock at the rate of 10 naira per shares, you want to sell it, you sell it at the rate of 20 naira per shares. That stock of share, that gain, that increase in value on that shares, you will pay capital gain tax on it. However, stock and shares, according to Finance Act 2021, for you to pay a capital gain tax on stock and share, that stock and shares must have a value not less than 100 million naira. That stock and shares must have a value not less than what? 100 million naira. That gain that you make on that stock and share, the proceed, that disposal amount of that stock and share must not less than what? 100 million naira. If the disposal of that stock and share is less than 100 million naira, you cannot pay capital gain tax. Somebody raise hand. You can ask your question.
Thank you, sir. Good evening, sir. Good evening, everyone.
Yeah.
So my question is around the sales of foreign currency. Is it more like a one-off sales, or take for example, if if a company earns is income in dollars, and then of course for the company to be able to meet the monthly obligations in terms of payment of salaries, acquisition of things, and all that. And then the company has to sell dollar on monthly basis. Will that be will the gain on each of the FX traded, will it be treated as capital gain tax?
Now, thank you for your question. For currency, any currency other than Nigeria currency, we need to just clarify it. Those companies that engage in sales, that their primary business is to sell dollar, make a gain. That means the forex company, the bureau de change, all those companies, that is their primary business. If those companies make a gain from disposal of foreign currency, they cannot pay capital gain tax. They will either pay company income tax on the gain. But this one that we are talking about, you are a company, you are individual, you buy dollar with the hope of selling it when it appreciates.
Okay. That's
Do
some
you
sort of
understand?
hedging. That's some sort of hedging or NDFs.
Yes, hedging.
Okay.
So you will pay
Okay.
capital gain tax. But
Okay.
for companies that deal with those companies that their business is to sell foreign currency and they normally make gain, they are approved by CBN. Those one, that is their primary business. So if they made a gain from that transaction, they will not pay capital gain tax. So rather, the gain that they made is going to be subjected to company income tax as a profit, because that's their primary business. Do you understand?
Very
So,
clear. Thank you.
yeah. So another asset subjected to capital gain tax. Another asset subjected to capital gain tax. All qualified capital expenditures. All qualified capital expenditures. All what? Qualified capital expenditures. E.g., plant and machinery, furniture and fitting, motor vehicle, land and building. They are all qualified capital expenditure. They are subjected to capital gain tax. If you made a gain while disposing a land, you buy a land, 100 million, you sell it 300 million, you have made a capital gain of 200 million, you will pay a capital gain tax. You buy a motor vehicle, 20 million. Later, when you want to sell it, you sell it. After using it for a while, you sell it maybe 25 million. You have made a gain of 5 million, capital gain of 5 million. You pay a capital gain tax. So they are all qualified capital expenditures. Another asset subjected to capital gain tax. Another asset subjected to capital gain tax. Digital currency, digital assets. We call it cryptocurrency. All those digital assets, online trading assets, like cryptocurrency, online gold, online crude, online commodities. So any digital asset in any form traded online, they are also subjected to capital gain tax. This one was included by Finance Act 2023. These digital assets was included by Finance Act 2023. And this Finance Act 2023, the effective date started in September 2023, which means as from September 2023, any company that made a gain from cryptocurrency transaction, online gold, online crude, online commodity, either you are a company or you are individual, such transaction will be deemed to capital gain tax liability. Another asset subjected to capital gain tax. Disposal of shares. We have talked about stock and share earlier. But that stock and share earlier that we talk about, we want to expatiate it now. If you dispose any share or stock that the value is more than 100 million naira, that stock and share is going to be subjected to capital gain tax. The only condition where disposal of stock and share that the value is more than 100 million naira will not be subjected to capital gain tax is when you reinvest the amount in purchase of another share within 12 months. Take, for example, I have a shares in Dangote Cement. I now sell the share. When I sell the share, when I dispose the share, I sold the share 120 million, all the share I have in Dangote Cement. If I don't want to pay capital gain tax, I have to reinvest the 120 million in purchase of another share in another company within 12 months. If I don't do that, that 120 million, any gain I made on the 120 million on disposal of that share is going to be subjected to capital gain tax. But if you dispose a share that the value is more than 100 million naira, that share that you dispose, you must use the proceeds of that disposal in purchase of another share. You must reinvest it in another company in Nigeria within 12 months. If you don't do that, you will be liable to payment of capital gain tax on that transaction. So all these are the assets liable to payment of capital gain tax. All these are the assets subjected to capital gain tax. You can be asked, list the assets subjected to capital gain tax, or explain the assets subjected to capital gain tax. Or you can be asked, what are the gains subjected to capital gain tax? If you are asked that you should, what are the gains subjected to capital gain tax? Your answer will be gains arising from disposal of, number one, incorporeal properties. Gains arising from disposal of an options. Gains arising from disposal of qualified capital expenditures. Gains arising from disposal of debt. Gains arising from disposal of digital assets. When a question is asking you, you should list out the gains subjected to capital gain tax. But if the question is saying you should list out or point out the assets subjected to capital gain tax, you can list them. Number one asset, incorporate property, such as goodwill, copyright, trademark, patent rights, digital assets, qualified capital expenditure, debt, options, disposal of share in excess of 100 million naira. You list them out. So you have to differentiate between how you can answer the question when they ask. You should list or explain the assets subjected to capital gain tax, or the question can be put in another way: gains subjected to capital gain tax. So you have to start your answer with gains arising from transaction relating to disposal of shares in excess of 100 million. Gains arising from transaction relating to disposal of digital assets, blah, blah, blah. Hope my explanation is clear. Do we have any question? Do we have any question? So in the absence of no question,
Hello,
let's
sir.
look at,
I'm
yes.
sorry to drag us back. There was a part where you mentioned something on stamp duties on assets. I didn't get
Yeah.
that quite well because I lost network at that point in time. So,
I'm talking of allowable expenses under capital gain tax. What are those expenses that are allowed? That if you want to compute capital gain tax, you can deduct them as incidental selling costs. You can deduct them from sales proceeds. What are those expenses? When you want to sell the asset, maybe you pay stamp duties on the deed of assignment, or you pay stamp duties on the transaction. You less it from the sales proceed. It's allowed. Or at the point of acquisition of the asset, at the point that you acquire, at the point of purchase of the asset, you pay some stamp duties for proper documentation of the ownership right on the assets. Such stamp duty is going to be capitalized as part of cost of the asset. It's going to be added to the cost of acquisition. So that is what I'm saying.
all right, sir. Thank you very much.
Yeah. Now, let's list out those assets that are exempted from capital gain tax. What are those assets that are exempted from capital gain tax? What are those assets that are exempted from capital gain tax? Number one asset exempted from capital gain tax. Gains from disposal of Nigeria government security or assets from disposal of Nigeria government security. What are the Nigeria government securities? What are the government securities? Treasury certificate, bonds. They are all government security. When you subscribe for Treasury or you subscribe for bond, later you dispose it off, you made a gain. Such gain you made on that transaction is not subjected to capital gain tax. So gain from disposal of Nigeria government security like bond, Treasury certificate, development stock, sukuk bond, when you made a gain while disposing them, you don't need to pay capital gain tax. Another one, gain accrued to any local authority. Local authority means local government authority. When any local government, they dispose land or they dispose motor vehicle, they are government. They dispose any asset, they now make a gain. You cannot ask local government to come and pay tax, to come and pay capital gain tax. They are exempted. They are still part of government. They are the third tiers of government. So they are exempted from capital gain tax. Another one, gain accrued to what? Educational institution of a public character. When an educational institution or an NGO, they dispose an asset, any company registered as a company limited by guarantee, that they provide, they are a public character company, they are charitable in nature, they are not making profits. NGO, when they dispose an asset, maybe they dispose land or they dispose motor vehicle or any of the assets of any kind, if they make a gain, they will not pay capital gain tax. They are exempted from capital gain tax. Another one, any gain Any capital gain on disposal of life assurance policy, you insure your staff for group life assurance policy. They now want to pay compensation on that. Insurance company want to pay compensation. If that compensation that insurance company want to pay is not subjected to capital gain tax. Another one, any capital gains from disposal of melder or decoration won for honor or valor or gallantry conduct. When you attend Olympic, you represent Nigeria in an Olympic. So at the end of the day, you are part of the team that won a gold. That gold given to you in an Olympic, when you want to dispose it off, you don't need to pay capital gain tax. Or you are one of the military that helped Nigeria to fight some insurgency war, and the war, the war was successful. So as a result of that, president need to decorate those officers that took place in the war. They now give them some honor, gold in form of gold or diamond or silver. You went ahead to dispose it. You don't need to pay capital gain tax. This one that I mentioned now, this Nigeria Tax Act that is going to commence January 2026 has removed this from asset exempted from capital gain tax. According to this Nigeria Tax Act now, if you dispose an asset, any gold or any medal or decoration as a result of your honor or as a result of your gallantry conduct or as a result of representing the country in a sport, if you dispose it off, you made a gain, you will pay tax from next year. It's stated clearly under the Nigeria Tax Act. But for our syllabus, they cannot test anything that relate to this the four new tax act that was signed by the president into law cannot be tested in our syllabus for now, because the commencement date is going to be January 2026. Do you understand? Some people believe that practically companies should start implementing it now, that 6 months is around the corner. It's already, the 6 months is already counting, that every company now should stand up, should look at how they will navigate from the old way, old computation to the new computation, that they should start the transition now, that the transition should have started now, that they should not wait till that January 2026. One of the transactions that you need to do as a company, you need to, your software, your accounting software you are using, some of them, on how you compute your personal income tax, on how you compute your company income tax, you need to update them. You need to review them. You understand? You need to invite tax consultant to advise you what is the impact of these 4 new tax acts. What impact is it going to have on your business? How is it going to affect your business? How is it going to affect your personal income tax that you pay on behalf of your staff? How is it going to affect your company income tax? In the new tax act that was signed into law now, there's no minimum tax. Minimum tax is no more useful again. So there is a lot of work for the tax consultants, but we are in the, this is an academic exercise. It's not about tax consultant issue. So any gain from disposal of medal or decoration won for honor is not subjected to capital gain tax. As at present, as from next year, is going to be subjected to capital gain tax. Another asset that are exempted from capital gain tax is any gain, any capital gains from disposal of chattel, your chattel, your personal chattel, your gold, your jewelries that you are using, you dispose them of, and the value is less than 1,000 naira. If you make a gain from that transaction, it's exempted from capital gain tax. But if the value exceeds 1,000 naira, you will pay capital gain tax. Another one. Any capital gain arising from disposal of asset acquired by gift. You are giving an asset. Somebody give you a car as a birthday gift. Later, you now sell the car. You will pay capital. That asset is a gift, so it's not subjected to capital gain tax. So it's not subjected to capital gain tax. It's by way of gift. It's not subjected to capital gain tax. Another asset that are exempted from capital gain tax that is not subjected to capital gain tax is compensation for loss of office. When you are paid compensation for loss of office, that compensation for loss of office is not subjected to capital gain tax, provided that the sum of the compensation is not more than 10 million naira. If the sum is more than 10 million naira, the excess of the sum is going to be liable to capital gain tax. When you are paid compensation for loss of office, the compensation for loss of office will not be subjected to capital gain tax, provided that the sum is not more than 10 million naira. If the sum is more than 10 million naira, the excess of the sum is going to be liable to capital gain tax. Another asset or gains exempted from capital gain tax. Any capital gain accrued to diplomats or diplomatic bodies. This one is talking of foreign embassy. All those foreign embassies that we have in Nigeria. UK embassy, American embassy, France embassy, French embassy. All those embassies, they are diplomats. If they dispose any asset in Nigeria, they make a gain. They are exempted from payment of capital gain tax. Even if they go and buy good in the market, they don't pay VAT. Diplomat, foreign bodies, all these diplomats, they don't pay VAT on the transaction. You don't deduct VAT for any good that they buy in Nigeria. So all these foreign embassies, if they go to market, they go and buy good, and that good is subjected to value-added tax, they will be exempted from payment of value-added tax because they are foreign embassy. Government exempt them from payment of value-added tax. Likewise, too, if they dispose any assets and they make a gain, that gain is exempted from capital gain tax. Because Nigeria government too, they have an embassy in other country. The embassy that they have in other country too, if they make a gain in other country, the other country cannot tell them to come and pay tax on that gain. So they are exempted. All this is to ensure that there is a good economic relationship between different countries and mutual understanding between different countries. That is the reason why most of the foreign embassies, they don't charge them to tax on their transaction. Another one, compensation received for injury or damage suffered. You receive an insurance compensation for injury or damage suffered. You don't need to pay capital gain tax. Compensation received for injury or damage suffered. You don't need to pay capital gain tax. That one is exempted from capital gain tax too. It's exempted from capital gain tax. Another asset exempted from capital gain tax. Another asset. Gains from disposal of land acquired by government by forced acquisition. You have a land. That your land, government want to expand the road. As a result of road expansion, government have to acquire the land through forced acquisition. That land, you buy it when you bought the land in 1985. Maybe you bought the land 5,000 naira in 1985. You now want to sell, government want to pay you compensation for forced acquisition of that land now because they want to do road extension, road construction. Government now said they will pay you 25 million naira because they have to demolish the building on your land, and that your land, they have to the road have to pass the land, so due to road expansion. That is forced acquisition. You don't have intention of selling the land. That capital gain on that land is not subjected to capital gain tax. Unless you have the intention before government come, you have been looking for buyer to come and buy the land. The land is already in the market that for buyer. Suddenly government now come that, we want to do a road extension. Oh, this is your land. You are going to acquire it by force. Since you have the intention before government come, you pay capital gain tax. But if you don't have any intention of selling the land before government forcefully acquire the land, you don't pay capital gain tax on any gain you make on disposal of that land, dead property, that landed property to government. So they are exempted from capital gain tax. So all these are the assets exempted from capital gain tax. All these are the assets exempted from capital gain tax. One of the assets that we have that is also exempted from capital gain tax is disposal of shares. In the case of merger and acquisition, one company acquire another company, or one company absorb another company. They now need to dispose the share. There is now maybe you now make a goodwill. There is a goodwill in the transaction when the purchase consideration is more than the assets, the net asset. That goodwill that you made as a result of merger and acquisition or absorption or takeover is not subjected to capital gain tax. So that goodwill that you made is not subjected to capital gain tax. Now, let's look at connected persons transaction under CGT. This is where we are going to stop this night. Connected persons transaction under CGT. Connected persons transaction under CGT. Who is a connected persons or connected parties? Connected persons transaction in tax, connected parties or connected persons, they are those parties that are related either through family relation or business relation. Two parties in a transaction that are close either through family relation or business relation. They are connected persons. Example, husband and wife, they are connected. Cousins, they are connected. Subsidiary company and parent company, they are connected. Associate company, they are connected. Joint venture, they are connected. Employee of a company is connected to that company. Now, when transaction under capital gain tax, when two connected persons transact business under capital gain tax, that means one of the parties sell assets to another party. We need to know the market value of that transaction, because transaction between connected persons is an artificial transaction. Transaction that is not done at arm's length. When wife sell car to her husband, that transaction is an artificial transaction. We need to know how much they are selling the car in the market. The amount that they are selling the car in the market is what we are going to use. That is the market value. Because of relationship between two of them, I may decide to sell my car to my wife. If I want to sell my car to my wife, I say, I'm selling it for you 3 million naira. Or I decided to sell my car to my brother. I sell my car to my brother 3 million naira. Because of the relationship, the family relationship between us, that 3 million naira is an artificial price. Tax authority have to look for how much they are selling the car in the market. Maybe they are selling the car 4 million naira in the market. If tax authority want to compute capital gain tax, they will not use your artificial price. They will use the market price in computing the capital gain tax. Because the buyer and the seller, they are connected parties. They are related either through business or family relations. So, who are the connected parties? Who are the connected parties? Who are the connected parties? Number one, individual is connected to his or her spouse. Number one connected party, individual is connected to his or her spouse. I'm connected to my wife. My wife is connected to me. I'm connected to my brother. Number two, a trustee of a settlement is connected to the beneficiary. Number three, partners in a partnership business is connected to other partners or spouse of other partners. Number four, a company is connected to his or her parent company or his subsidiary or his associate. So these are the connected parties. An employee is connected to his or her employer. It's also a connected person. So the summary part is when there is a connected person transaction, look for the market value. It is the market value you are going to use as the sales proceed, not the value that the connected persons use to sell the assets. It is the market value you are going to use, how much they are selling it in the market. Hope my explanation is clear. Are you with me?
Yes, very clear.
Yes, sir.
We are with you, sir.
Yes,
So
sir.
this is a connected person's transactions. Now, let's look at example. This is where we are going to start this night. Somebody should help us read this example 1. Someone should help us read. Oh, yeah. Oh, yeah, somebody should help us. Just read the example 1 so that we can look at it. Example 1. Cowboys Limited is a manufacturing company based in one of the major cities in Nigeria. In its bid to reorganize business for future profitability and growth, the board of the company approved the underlisted transaction during the year. A motor vehicle which was acquired in August 2019 for how much? For 2.7,500,000, 2,750,000, for 2,750,000 was sold to the general manager in October 2022 for how much? For 2,550,000. The market value of the motor vehicle at the days of disposal was 2,900,000. Required. Compute the capital gains, if any, and the capital gain tax for the transaction. Look at it. This company, Cowboys Limited, they acquire a motor vehicle. What is the cost of acquisition in this transaction? What is the cost of acquisition of the motor vehicle?
2.9 million, sir.
No,
The cost of acquisition.
2,750,000.
Okay,
This
sorry,
is the
2
cost
million,
of acquisition. 2,750,000. They now sell it to who? To the managing what? To the general what?
The general manager.
Manager.
General manager, sir.
That means it's a connected person transaction. Connected person, Abi?
Yes, sir.
Yes,
Because
sir.
the manager is connected to the company.
Company.
Look at how much they sell it to the general manager. They even sell it more less than the cost of acquisition, which is not supposed to be so, because motor vehicle normally appreciate.
Yeah.
How much they are selling it in the market?
2.9 million, sir.
If we want to compute the capital gain tax now, what will be our sales proceed?
2.9 million.
Our sales proceed is going to be 2.9 million naira. Our sales proceed will be 2.9 million naira. What will be our cost of acquisition? How much do we acquire the assets?
2,750,000.
So our cost of acquisition is 2,750,000. Sales proceed. We don't have any incidental selling expenses. Dash. So your net sales proceeds still remain 2.9. How much is your cost of acquisition? 2,750,000. 2,750,000, less it from 2.9. That means your capital gains 150,000. Your capital gain tax 10% of 150,000.
15,000.
15,000. 15,000, sir.
15,000. Be part of the question. State date when the tax liability is to be paid to the relevant tax authority. When do we pay the capital gain tax to the relevant tax authority? Who can tell me?
30th June and 31st of the year.
This transaction, when do we pay the capital gain tax?
Okay.
The capital gain tax must be paid on or before
31st
December 2022.
31st
December
December 2022. 31st December 2022. Look at the dates that we dispose it. October 2022. The due date of payment must be 31st of December 2022.
22.
That is the due date. Must be paid on or before December 2022. So, ladies and gentlemen, this is where we are going to stop this night. By next class, we will start with partial disposal of fixed asset. Any question, any issue, any observation?
No question from this side, sir.
Okay,
No
so in the
question,
absence
sir.
of no question,
Apologies, sir. I have a question.
okay.
So, I'm thinking about. I mean, is it in all cases where a company dispose of assets that they charge or they must do CGT on it?
Is the asset listed as part of assets subjected to CGT? You ask your question. If it is land, it's listed. If it is building, it's listed. If it is plant and machinery, it's listed. If it is furniture and fitting, it's listed. You need to pay CGT. So it's in all cases, since the asset is listed as part of those assets subjected to CGT. But when you sell your land to government as a result of forced acquisition, government acquire it by force because of road expansion, you don't need to pay CGT. It's exempted from CGT. When you receive insurance compensation, you don't need to pay CGT.
So I would have thought that, thank you very much, sir, for your comment. I would have thought that if a company is into, maybe maybe take, for example, equity professionals, and then each of our facilitators, they had vehicles, they have cars, official cars owned by the company. Yeah. So in event that the pioneers or the CEOs or so, they decide that okay, you know what, we just want to sell this vehicle to the facilitators. So in that case, they would have to charge CGT on the disposal of that or the transfer of the ownership to them, right?
Yes, they will charge. Equity professional will pay CGT if they made a gain from disposal of the assets. If the equity professional sell the assets more than the cost of acquisition of the assets. And mind you, selling assets by equities professional to facilitator is an artificial transaction. It's a related party transaction. We need to consider the market value because we are related to each other. So the facilitator, they are employee of the equity professional. So it's an artificial transaction. We need to consider how much they are selling the asset, the motor vehicle in the market. That is the market value. That is what we are going to use. Thank you for having me. Have a nice day.